Imagine if every time your stocks experience a sell-off, you could use that market weakness to lower your tax bill while staying invested for future growth. That's exactly what tax loss harvesting lets you do. Some investors just ignore volatility or they assume that it's a mild setback. My clients, they turn those historically temporary losses into tax write-offs. In this video, you'll see how the strategy works and how you can start using it to build long-term wealth. So, how does tax loss harvesting actually work, and how could you use it to keep more of your market gains? By the end of this video, you'll know what tax loss harvesting is and how it can lower your tax bill. How direct indexing makes this strategy even more powerful, when and how you can actually use those tax write-offs to maximize your savings. Let's say you're at a grocery store, and when you check out, you realize you have a coupon that you could have used to save $20, but you forgot to use it. Pretty frustrating, huh? Well, when you ignore market volatility, you're basically throwing away a tax-saving coupon. Some investors make the mistake of just ignoring it instead of using these moments strategically. Tax loss harvesting lets you cash in on those historically temporary losses to reduce your tax bill without having to sit on the sidelines, missing future market growth. Here's how tax loss harvesting works. Step 1. Sell an investment that's at a loss. Step 2. Use that loss to offset taxable gains from investments you sold or will sell at a profit. Step 3. If your losses exceed the gains, you can deduct up to $3,000 against your ordinary income. The fourth step. If you still have leftover losses, you can carry them forward to offset gains in future years. They're not bound into the year that you realize them. An example, let's say you had $10,000 in stock gains this year and $8,000 in losses from another investment. If you use tax loss harvesting, your capital gains will be reduced first. That means you only pay taxes on the $2,000 net gain, not the full $10,000. And what if your realized losses are bigger than your realized gains? You can reduce your taxable income by up to $3,000 and roll the rest forward. But what if you don't want to sell and sit in cash? You just sold a position, so what now? That's where the next part comes in. The IRS has a rule to prevent people from abusing tax loss harvesting. It's called the wash sale rule. Basically, you can't sell a stock at a loss and buy the same stock back within 30 days. If you do, the IRS disallows the loss, and you lose the tax benefit. How do you stay invested while not violating the rule when the market is actually selling off? So, one example is that you could sell a position you have in Coca-Cola and buy Pepsi. Coca-Cola and Pepsi are in the same industry, but they're different companies. Or you could sell one tech stock and rotate into a different tech company. Or you could sell an S&P 500 ETF that you own and replace it with a total market ETF. This way, you lock in the tax savings while keeping your portfolio invested. There are some people who hear the words realized losses and are convinced that they're losing money, that this strategy is designed to lose. The truth is far from it. Just because you're realizing losses does not mean your portfolio is losing value. When you sell a position that's down, instead of just sitting in cash, reinvest the money you just raised back into the market. Historically, the stock market has increased in value over time, so it's very possible that you'll generate tax write-offs and grow your portfolio's value in that very same year. Now, what if you want to automate this process and make tax loss harvesting easy? With traditional index funds, you own one big ETF, which means fewer opportunities for tax loss harvesting. But with a strategy called direct indexing, instead of owning an ETF, You would own individual stocks or multiple ETFs that make up an entire index. This gives you more chances to sell underperforming stocks while keeping the winners, a consistent way to harvest tax losses without changing your overall strategy, a powerful tax saving tool for investors with taxable accounts. If you're managing a taxable or non-retirement portfolio, direct indexing gives you way more flexibility, but you can take advantage of those tax saving opportunities all year long. Now let's talk about how to actually use these write-offs in real life. Remember, here's how you can apply your harvested losses. First, they would go to offset capital gains. This would reduce taxes on investments you sold at a profit. Then you can deduct $3,000 per year against ordinary income. And finally, you can carry forward leftover losses to offset future gains in future years. A pro tip here is you can even use losses from one account to offset gains in another account or from the sale of real estate or a business. These write-offs belong to you, not to the portfolio itself. So for example, if you sell stocks at a loss in your brokerage account, you can use those losses to offset gains from a real estate sale. This is how high-income investors use tax loss harvesting to keep more of their money year after year after year. Myth number 1, tax loss harvesting is only for rich people. The reality is, it benefits anyone with taxable investments, not just high net worth individuals. Even if you don't have huge capital gains, you can still use up to $3,000 of losses per year to reduce your federal income tax. Not all of my clients are ultra high net worth people, and you don't really have to be one to use a portfolio like this. Myth number 2, you have to sell everything to benefit. The reality is you don't need to sell your whole portfolio, just the stocks or the funds that sold off. Smart investors selectively harvest losses. Now you know how to use tax loss harvesting to lower your tax bill. But here's the thing. This is just one piece of a much bigger strategy. If you really want to grow your wealth while minimizing taxes, you need to structure your entire financial picture the right way. I'll break it all down in my next video where I show you 3 powerful strategies for tax-efficient investing. Click here to watch it now. I break it all down for you in my next video, where I show you 3 powerful tax strategies for tax-efficient investing. Click here to watch it now.